In this video, I want to talk about the debt service ratio, or the DSR. So if you want to buy a new house or condo, how do you actually determine if you can actually afford it? Okay, so what is a DSR and why is it important for you? Basically, the DSR is a method used by banks to calculate whether or not you can actually afford a specific loan. Okay, so here's the formula. DSR equals to the total commitments per month divided by your total net income per month times 100%. And as a general rule of thumb, it has to be below 70% to be on the safe side. So the lower your DSR, the better, and also the higher chances for your loan to get approved by the banks. Okay, so here are some one of the most common different types of total commitments, such as your mortgage or property loans that you currently have right now, hire purchase loan, your car loans, personal loans, PTPTN, ASB financing, business loans such as your SME loans, and also your credit card debt. Now for the credit card debt, this one is a bit interesting. It depends on your outstanding balance. So the total amount of credit card debts that you have across multiple credit cards, 5% of that amount is counted as a general rule of thumb for each month. So for example, if you have an outstanding balance of 10,000 ringgit, and then you can count the monthly commitment for your credit card to be about 500, because 5% of 10,000 is 500. Okay, so yeah, that's basically what the total commitments is. Pretty much any loans that you have under your own personal name from any banks. Alright, so remember, the banks are actually in the business of lending money. So they lend money to you in hopes of you paying more money in return in the future, right? Based on the interest rate that they provide. Now, where can you find your total commitments per month? Okay, it's a short answer in your CCRIS, which is your financial report card. So you know that your SPM is your educational report card, where it determines it shows how many A's, how many B's, how many C's you get. Now, the CCRIS is your financial report card for any loans that you have under your own personal name. So this is how it looks like. So basically all of your outstanding loans, your mortgage loans, car loans, personal loans, will be listed out in here. And you can use this information to calculate your DSR to determine whether or not you can afford the new loan that you want to apply for. How about your total net income per month? Well, basically it's your gross income per month minus your zakat, EPF, SOCSO, taxes, and maybe any additional expenses. So that will equal to your total net income per month. Alright, so what will affect your DSR? So whether your DSR is good or bad, it depends on several factors. One, the stability of your income. So it depends on your job industry, if you are an employee, or what type of business you have. The more riskier, the harder it is for you to actually get the loan from the bank, right? So for example, a lorry driver. A lorry driver is considered by the banks to be a risky kind of job, because the lorry driver can lose their job at any moment. Second, the source of income. Whether you're an employee or self-employed, where are you getting the money from? Because some people, they might say they have a business, but they're actually getting their money from selling drugs, and that's what the banks want to avoid. They want to avoid any illegal income. And here's another fact. Banks, they actually love employees more than self-employed or businesses. Because of what? Employees, they have a stable income every month. So the banks they feel more secured that the person can actually pay their monthly repayments. But for businesses, it depends. Sometimes it's high, sometimes it's low. Okay, third factor, credit score, your CCRIS and your CTOS. Okay, CCRIS, they basically outline all of your outstanding loans that you have from the banks. As for your CTOS, it's a little bit different. It also it's also about your monthly commitments, but the smaller bills are electricity bills, water bills, Wi-Fi bills. So make sure you pay all of those as well, because it does go into the bank's considerations whether or not they want to give you the loan. For the credit history, so how many loans do you already have? Is it too much? If it's too much, the DSR is going to be too high, or DSR is going to burst, so the banks won't give you the loan. And it will also be a problem if you don't have any outstanding loans before this. So if you're starting off fresh, that's also a problem for the banks. Even though your income might be high, DSR, everything okay, they see that as a risk because they can't see any past records. Okay? And if your DSR isn't good, how can you improve it? Well, two major ways are. You have to reduce your debt or increase your net income. So I think one of the best ways to reduce your debt is to actually set off your higher interest loans, such as your credit card debts. And for increasing your net income, maybe you can get a side hustle, start a small business on the side, and it can even come from your rental. If you have a property investment, and then you can actually count the rental income from your tenant as your additional source of income. Okay, and you can actually improve your credit score by not making any late or missed repayments on your loans for your secrets and your CTOS. Always make prompt payments. Another thing I want you guys to understand is the banks actually have very strict policies. Different banks, different policies. They're not all the same. They're individual businesses of themselves. And one of the things is the DSR, the maximum allowable DSR limit for different banks are different. So here's some maximum allowable DSR limits based on your gross or net income for different banks. Now, I can't take credit for this because I actually got these visuals from Mortgage Sifu. You can find them on Facebook. Right, so I'll give you an example. Affin Bank. Okay, so if your gross salary is below 5K, then your maximum allowable DSR limit is 60%. Gross salary 5 to 10K, 70%. Gross salary 10K above, 80%. So it depends on your salary. As for Bank, they will look at your net salary, not your gross. Net salary up to minus all of the expenses. So if it's below 10K, then your DSR will be the maximum DSR 70%. Above 10K, 75%. So as you can see, different banks have different DSR limits. And also, according to the supporting documents, TA, okay, this TA actually means tenancy agreement. So if you have a property investment, you have a tenant inside that property paying you rental income. Different banks, they will count how much they're going to count from the rental income as your additional income. For Affin Bank, the rental income, they will count 100% of it. AIA, only 70% of it. As for Bank, 80% of it. So you can look through all of these and see according to which banks you want to apply the bank loans from. So here's some other examples from different banks. These are all of the major banks inside Malaysia. Okay, so I've actually provided some do-it-yourself examples to calculate the DSR for yourself. So this first box over here is the total monthly commitments. And remember, include the new estimated monthly installment that you're going to have to pay for your new house that you want to get the loan for into the total monthly commitments. And all of that divided by the total net income per month. So I'll give you about 3 seconds. You can pause this video and calculate these answers. After that, I'll show you, explain one by one. Okay, so for example number 1, the DSR will be 63.3%. This is still okay because a general rule of thumb, below 70%, okay. Second example, okay, the DSR is already at 87.5%. What does this mean? Okay, this is what we call DSR burst, meaning that the monthly commitments are too high for the net income that they have. For number 3, 48%. Okay, this is actually still okay. All right, so we're nearly at the end. Bear with me. So how can you get your home loan? So now that you understand that how the concept of DSR and how to calculate your own DSR based on your total commitments per month and also your total net income, here are some simple rules for you to follow. Maintain a low DSR, preferably in a range of 40 to 50%. So the lower your DSR, the better. And okay, before you apply the loan from the bank that you want, I'm sorry, make sure you find the maximum allowable DSR limit based on your gross salary or your net salary. So it saves time for you and the bank. Maintain a good credit score and credit history. Yeah, so make prompt payments. Make sure you don't miss any repayments to make your secrets and CTOS scores perfect. And also, if you're a beginner, start small and work your way up. One of the best ways is to start with a simple credit card. Just apply a simple credit card from any banks and use it. But make sure that you make prompt payments. So don't how do you say? Don't gather up the debts because that will defeat the purpose of you actually getting the credit card in the first place. Alright, that's all for this video. I hope that I explained everything to you in detail about DSR. So the next time you want to find a home, next time you want to, so the next time you want to determine if you want to get a great home and determine whether or not you can actually afford the home loan, yeah, use the DSR. Thanks for watching and I'll see you in the next video.